All right, welcome everyone. So excited for you to be here for this fantastic lunch with the leader, what every bookkeeper should know about this. A little bit about me. I am Cindy Schrader. I'm the founder of Bookkeeping Buds. And if you are not familiar with Bookkeeping Buds, it's when I started my business 15 years ago, I knew I didn't want to run my business on my own. So I wanted to create this network around me, and it's kind of blossomed into, we have 70 members across the country, all made up of bookkeepers running their own firms. And we have a lot of different things that go into Buds. We have calls to stay connected each month. So we have a magic hour call, which is open to everyone. We have our lunch with the leaders, which is also open to everyone to give back and share knowledge with everyone. And then as a member of Buds, there's also additional calls that we have a member call. And then we have also a series called Share Your Success. We are actually going to be announcing a new group program that we're going to be starting as well. That's going to be announced next week. So if that's something that you're interested in, be on the lookout for that. Most importantly, I think, or the biggest benefit of being a bookkeeping bud is we have a private Slack channel. And so we share all of our information on that private Slack channel instead of a Facebook group or anything like that. So that's kind of the biggest benefit. And we also have a directory, but it's not muted and I'm not finding them. If you can mute yourself, that would be fabulous. We also have a directory on our site. And the biggest piece of Buds is that security that you have a team of cheerleaders around you to support you and help you with your questions as they come up, dealing with clients, dealing with just all the everyday things of running a business. If you want to find out more about Bookkeeping Buds, check us out at bookkeepingbuds.com. You can click join and become a member today. Our community starts at just $35 a month. And if you are a member on our call today, if you want to put in chat, maybe something that you benefited from being a member, that would be fabulous. So without further ado, we're going to go ahead and get started with our Lunch with the Leader presentation today, which is being presented by our very own Nancy McClellan, the dancing accountant. And so I'm just going to give you a little synopsis about Nancy. As a principal of her firm, the Dancing Accountant CPA, Nancy McClellan has been on a 20-year-long mission, I think it's 21 now, mission to provide affordable, quality accounting and advisory services to independent business owners. She's been a winner of AI's 2022 Best SME Accounting Services in the US. She's also previously been named one of Ignition's top 50 women in accounting. And I am sure one of her highest honors was being named Bookkeeping Bud of the Year in 2020. She writes an award-winning blog with insights and resources for small businesses and accounting professionals that you can find on her website, thedancingaccountant.com. She is the member. She is a member of 3 different dance troupes and can be found on Chicago stages, entertaining audiences that often include her clients. So she's going to be giving away a raffle prize as well, a book called Accounting for the Number Phobic by Don Fotopoulos. So please stay for our whole session. Put your questions in the chat if you have them. She's obviously can't go over everybody's questions, but we're going to get to as many as we can. And you put them in the chat, it'll help her to, write additional blogs in the future as well. So I'm going to go ahead and pass it over to you, Nancy.
Thanks so much, Cindy. Thank you for having me. I'm really excited to be here today. And, just now when you mentioned that one of my highest honors in life was being named Bookkeeping Bud of the Year a couple years ago, I realized I actually have my tiara from that sitting here at my desk. My sash is up there too, so I'm not going to wear it today because, I don't want to distract you all from the serious topic here, but I do have, that was not planned. That's where it lives. It really was a high honor. I'm Nancy. Hi, everyone. First, before I do anything else, I want to mention that I'm going to be holding off on answering all questions until the end, but please share them in chat as you think of them. And Cindy's going to keep track of them so that the ones I haven't already answered by the end, which hopefully I'll get to most of them because I know we have a lot of the same kinds of questions about taxes. But any that I haven't answered by the end, hopefully they'll be able to have their moment in Q&A. Also, I encourage you, if you have the little responses, the little emoticon responses at the bottom of your screen, I encourage you to use those to stay engaged throughout the session. But especially at the beginning of each topic, I'm curious by emoticon reaction, how many people have had issues in that particular area that we're going to cover. If I forget to mention it, just go ahead and do it anyway. It helps us all to know we're not alone. It's not easy. Stuff happens. Some of these areas are pretty intimidating and pretty frustrating, and so feel free to communicate via emoticon response there. So, as Cindy mentioned, I am Nancy McClelland. I run a CPA firm called the Dancing Accountant. Our team is 100% remote, and we have 7 part-time bookkeepers and 2 CPAs. And what makes us a little different than I think a typical CPA firm is that we actually really like to straddle the worlds of bookkeeping, accounting, tax, and analysis. We see the relationship with our small business clients as a partnership, and we really feel like we're part of their overall team, not just somebody that they come to once a year to get their taxes done. I also write an award-winning blog, and education is my passion, which is why I am so glad to have this opportunity to talk with you today. Um, this is the slide that basically says, please don't sue me. I'm just trying to help. I make mistakes too. It happens. So who can prepare tax returns? Legally, anyone, but I don't recommend it. I'm a CPA and a tax preparer. I often use those terms interchangeably, but they are different, and you don't have to be one to be the other. Now, unlike some CPAs out there, I actually started out as a bookkeeper, and as a result, I embrace bookkeeping technology. I see the proper flow of data through QuickBooks as an essential part of what helps small business owners really use their books to make real-time business decisions rather than just some awful thing they have to do to get their taxes filed each year. So with the exception of the actual income tax returns themselves, there is nothing that we do in our firm that all of you can't do in your own bookkeeping firms if you get the training and the experience. However, I would say that tax law is complicated enough at this point that I don't recommend doing taxes for compensation without getting some sort of credentials. Legally, you can, you are allowed, but I don't recommend it. So, you're a bookkeeper and you are great at your job. Is that my right slide? There. You're a bookkeeper, you're great at your job. You understand the flow of data through QuickBooks. You're an expert in countless apps in your tech stack. Your debits and credits always balance. You're amazing at what you do. All of you are, especially you out there who are already buds. I know you're incredible. You did not study and work hard all this time to become a tax preparer. So why should you give a flying frog about taxes? Like why are tax rules important at all? We're going to discuss some items that are tax and accounting related that can help you become better at bookkeeping and improve your ability to work with CPAs and other tax preparers. But most importantly, learning this information will help you add value in your client relationships, which in turn allows you to step into a trusted advisor role, and it will help you build your reputation with tax professionals who will in turn refer clients to you and help you grow your business. So I encourage you to think of these suggestions not as just like another to-do list that makes your job even more complex and demanding than it already is. It's not like that. It's actually an opportunity. All of these are opportunities to be a hero to your client, to take the load off of your tax colleagues and impress them, to stand out above the rest, and to really distinguish yourself as somebody who pays attention, who's got your back, who has the knowledge and insight to really make a difference. So that's why you should care about taxes, even if you don't do taxes. I'm sure you know that you're often the first line of defense when it comes to catching things that might be too late if clients wait to talk to their CPAs until tax time. By the way, I use CPA and tax preparer interchangeably often. They're not actually interchangeable. As I mentioned earlier, you don't have to be one to be the other. But if I say CPA or tax preparer in this conversation, in this context, it means the same thing. So you also might have knowledge that could help the client, not only if it's too late if clients wait to talk to their CPAs until tax time, but also things that maybe the tax preparer wouldn't think to bring up without the bookkeeper mentioning it at tax time. The client might not think to bring it up, the tax preparer might not think to bring it up, but you will know that maybe it's something that should be brought up. So I'll throw out a couple of examples. Knowing that sole proprietors and partners can't receive W-2s, but S Corp and C Corp owner employees must receive W-2s. That is a really important detail for the bookkeeper, because a small business owner could get all the way through the year being paid wrong and not find out until it's too late, like once the CPA is doing their tax return. And along the same lines, knowing that C Corp and S Corp owners have to be paid reasonable compensation via W-2, knowing like what that is and how to calculate or at least eyeball it, that's a crucial issue to address during the tax year because it's too late once the return is being prepared. So bookkeepers are really that first line of defense. But just as importantly, you don't have to be a CPA to understand reasonable compensation. Like this is a topic you can study and become an expert in, and you can charge your clients for that expertise. Your clients are happier, their tax preparer is happier, you're a hero who's being paid for the value you bring to the table. So while you may not necessarily be doing tax returns, you are becoming an expert in other areas that are related to that annual tax preparation, and you're being paid for it. So on the slide in front of you is these are the areas we're going to touch on today. I want to make it clear, I could give an entire talk about any one of these areas. Okay, so we're not taking any deep dives here. You do not have to memorize how this all works. This goes for everything in this talk. Keep a cheat sheet or look it up online. It's not about memorizing all of these rules. The key is to know where the challenging areas lie and to have a little warning alarm go off in your head and be like, oh, wait, hey, wait, I'm in that territory. This should, warn you that you should look into it further, that you should ask questions, that you should go back to your notes or do a search online. So since I started out with a couple of examples regarding differences between entity types, let's stick with that topic and go there next. So entity choice. The first thing to do when you get a new client, get a copy of their organization or incorporation documents and a prior tax return if they were already in business. I could tell you some real life horror stories from the times I skipped this step. Don't do that. Don't say, oh, well, the client's sure they're an S Corp, so they are. No, people often have no idea what entity type their company is, or they have it stuck in their head that they're one type but not another, or they don't realize that they've made an election to be taxed as a different type of entity. So just get that paperwork, get something that proves it. Proper bookkeeping depends on knowing what kind of entity your client is. So the business types that are out there are sole proprietor, partnership, S Corp, C Corp. There are also co-ops and nonprofits. I'm not going to talk a lot about co-ops and nonprofits today because they are kind of these special beasts of their own. They mostly follow C Corp rules, but they have all sorts of special areas. So I'm going to concentrate on the other types of business entities. Here's something really important. If you take like one thing away from this talk, LLC is not an entity. It is not an entity type. LLC is a state-only form of liability protection, and it's considered disregarded, that's the term, disregarded for tax purposes, which means that whatever form you would file without it that's what tax form you're going to file. That's what you are, unless you make an election to be treated as a different type, which is a thing you can do. So for example, my company, we're a single member LLC that has elected S Corp tax treatment. So I file an 1120S. Even though I'm an LLC, I'm filing an 1120S. So LLC doesn't tell you anything about what entity type they're going to actually file as far as their taxes are concerned. Very important to remember this. Now, each entity type has its own tax return. For a sole proprietorship, you have a 1040. There's a special schedule called the Schedule C that you would file your taxes on. If you have rentals, which I know some of you have rentals, it's not technically a business type, but that would be Schedule E on their 1040. That is something that kind of know that that's there. We're not going to talk about about those today. We're going to focus on the Schedule C side of sole proprietorships. 1065 is what you would file for a partnership. 1120S is for an S Corp. 1120 is for a C Corp, which is a little confusing because 1120C is for a co-op, not a C Corp. So that can be confusing too. And 990, there's a whole series of those for nonprofits. So here's what I recommend. Once you figure out what kind of entity your client is actually going to be filing their taxes as, pull up a blank copy of that tax return on irs.gov, .gov, not .com. That's a different thing. You don't want to go there. .gov. Pull up a blank copy of the tax return type and look at the fields on it. Just like look at the main pages. Sometimes it's just one page, sometimes it's like 5 pages. Look at the main pages of it, look at the fields, and make sure there's a one-to-one correlation between each slot on there that the client would be using. I mean, obviously, if they're not mining, they're probably not using depletion, right? But any of those slots that the client's actually using or likely to use, make sure there's a one-to-one correlation between that and the chart of accounts, right? So if it says insurance on the front of it, on your tax return, there's a slot for that. Make sure there's an insurance account that follows those rules. If there's a repairs and maintenance, make sure there's a repairs and maintenance account, utilities, etc. They are not the same from one tax return to the next. You would think they are. It is totally weird. It is just completely baffling, frustrating beyond compare. I can't even tell you. But them's the rules. They are not the same. So look at the specific one. You can certainly and almost always will have additional accounts besides the ones that are on there. Of course, you're going to have plenty of those. But make sure to at least have these and don't combine them with any other account. In other words, don't make the CPA at tax time sift through an account for certain items that go on like this slot, this field on the tax return. Make sure if there's a field on the tax return, you've got an account for it, okay? Let's talk about differences by entity in terms of payroll and income taxes. This is not something that you have to memorize, but it is definitely something you should put on a cheat sheet somewhere because it's really important. This is like the basics of how these entities differ from one another. So sole proprietors also could be a single member LLC. They pay self-employment tax. Now, self-employment tax is Social Security and Medicare. They pay self-employment tax and income tax on 100% of their profit. End of story. Not how much they take out of the company, what their total profit is. Same thing happens with partners in partnerships, often also multi-member LLCs. They pay self-employment tax and income tax on 100% of their profit, but they also have a complicated legal structure and they track how their payment for services is different than profit distributions. But at the end of the day, they are paying the same amount of taxes on the same kind of income that a sole proprietor would, okay? It's a pass-through entity, a partnership, which means that it has its own tax return and then via a K-1, it's gonna flow through onto the personal return. Whereas a sole proprietor, they're just filling it out on their personal return on a separate page to begin with. Now, an S Corp is also a pass-through entity. You see this abbreviated as PTE a lot, pass-through entity, which means they also have a K-1 that brings these items of income and deductions onto the personal return. But what they pay in taxes is way different. They pay payroll tax, which is akin to self-employment tax in the sense that it's Social Security and Medicare, and income tax on their W-2 wages only. Okay? On their W-2 wages only. Very important. They also pay income tax, but no Social Security and Medicare on their profit. And this is why people talk about S Corps saving money on taxes, because you're only paying the 15.3% of Social Security and Medicare. You're only paying that on your W-2 wages. So you're like, oh, this is great. I'm going to give myself a W-2 for like $10. And then I don't have to pay self-employment tax or payroll taxes on anything else. But you can't do that because there's this thing called reasonable compensation. Reasonable compensation means what would it cost to hire someone to do the same job that the shareholder employee is doing? What would it cost? That's how much you have to pay yourself. There's a whole world of calculating reasonable compensation out there. It's one of the areas where I'm an expert. I love it. We should do a class on reasonable compensation, Cindy. That would be a blast. Um, so the tax savings isn't what you would think it would be because you still are paying, on the W-2 amount, which has to be reasonable, you're paying that. But let's say that you have a lot of employees that are generating wealth for you, or you have a lot of equipment that's generating wealth for you, and you have a lot of profits beyond what reasonable compensation is. Well, you only have to pay income tax on that. That's the investor hat of yours. That is just paying income tax on your return on your investment. Another thing I want to say about it, though, is that the tax savings is not what it used to be. 5 years ago, when the Section 199 Cap A qualified business, QBID, qualified business income deductions, really complicated stuff. When that came into being, it actually decimated a lot of the tax savings of being an S Corp. So it's not the obvious way to go anymore. I say this because everybody's just like, oh, S corps don't pay tax. It's not like that. Yes, there is a tax advantage. Here's why there's a tax advantage, but it's not always as big as an advantage as you might think it would be, especially if it's just one person and they don't have any employees or big equipment or anything like that. Now, C corps, almost never the answer because there is double taxation of profits. So you get a W-2 for the services that you render, just like the S corp does. The company is paying tax on the profit because it's not a flow-through entity. So the company pays corporate income tax on the profit of the company. And then when you get any sort of distribution, it's a dividend. And that's taxable income to you. So let's look at this. We don't want this. We don't want to both be having the company pay taxes on the profit of the company, and then you paying tax on the dividends that are given to you. So C corps, you do not see them a ton for small businesses. There are reasons for it. Definitely, they're out there, but generally, it's generally not going to be the answer. So let's talk about the differences in how the owner is paid. We've got payroll, guaranteed payments, draws, distributions, dividends, so many different things to choose from. If you're a sole proprietorship or a partnership, the owner or partner cannot receive W-2 wages. Write that down. They cannot receive W-2 wages. If you have a client that is a sole proprietor or a partner, and that person, their employees receive W-2s, but that person is getting a W-2, you have a problem on your hands. You're going to have to reverse those wages. You're going to have to do amended 941 X forms. They cannot have wages. They can get draws and distributions, and in the case of partners, they can also get guaranteed payments. Draws and distributions go into the equity section of the balance sheet. They're essentially drawing down the business's value. So the company's creating all this value, and then you're reducing the value by taking money out of the company. So that makes sense. The S Corp and the C Corp shareholder employees, they must receive W-2s. It's exactly the opposite. And to make it really complicated for S Corps, they also have to have their health insurance get reported on their W-2 and then take it as a deduction on their personal tax return. It's a big pain in the butt, but that's just the way it is. So again, if your client is an entity and you know they're filing taxes as an S Corp or C Corp and you don't see any W-2 wages for them, you need to have a conversation. Maybe it's on purpose, but chances are it's not. Partners. Let's go back to partners for a second. Because partners generally receive guaranteed payments for their services rendered and distributions for their profit. As I mentioned before, they're taxed exactly the same, but they are reported differently. Guaranteed payments are going to go on the profit and loss like payroll. And that's because you could have a bunch of partners in a firm and some of them are doing all the work and some of them are just, more like investor partners where they do less work. And so you want to be able to make sure that the people who are getting paid for their services rendered, that you're looking at that as cost of labor on the profit and loss. But taxation wise, same. It is very important as a bookkeeper to note the different types of draws and distributions in the memo of your client's transactions. So if it's a profit distribution, or if they're paying estimated tax payments, or maybe making a payment to charity out of distributions, anything related to the home office, anything that they need to track that's personal but business related, like maybe auto expense, a lot of times these are run through the draws or distribution accounts. And they're not all created equally. You know, taxation wise, it's the same, but you might want to track them differently because you're going to need that information at tax time. So be really good with the memos. And I use a lot of sub accounts in my distribution section. I'll talk about that a little bit more later. I want to circle back one more time. Distributions from a C Corp must be treated as a dividend. It's not just when dividends are authorized by the board, right? Like if you paid personal expenses accidentally out of the company, or if they have an automobile and it's getting paid for by the business, anything for C Corp that you would normally put in distributions, those are going to get taxed as dividends. You've got to send a 1099-div. It's required. So it's another reason C Corps are kind of not so much fun because they have a lot of burden there administratively. Benefits, just going to touch on these real quickly. Health insurance premiums for owners are also treated differently for each type of entity. So self-employed health insurance for a sole proprietor is deductible on the personal return for a profitable Schedule C sole proprietor and for partners. So though you're not going to want those to be on the profit and loss. S Corps are entitled to the same personal deduction, but they've got those weird rules where it has to go on the W-2 and then you can take it as a deduction on your return. So catch those before year end because you got to get that on the W-2. Health insurance and HSA payments for C Corp owners, those are treated exactly the same as it is for their employees. That part's super simple. Retirement payments for a sole proprietor is going to be a draw. For a partner, it's going to be a guaranteed payment. And for a corporation, either S Corp or C Corp, that's going to go on the P&L. So the takeaway, payroll, benefits, taxes, they are different for each entity type. There are no two entities that are alike. So know the entity when tracking these types of costs. The rules may be complex. You don't need to memorize all the rules. Learn what type of entity they are, then look up what those rules are for that entity. So specifically with payroll, this is just sort of a subset of stuff we've already talked about. You need to be asking yourself questions. No need to memorize. Know it's a thing. Just know it's a thing. Look it up. Who has to get a W-2 and who can't? What's the difference between guaranteed payments and distributions? What is reasonable compensation anyway, and why is Nancy so in love with it? What is the difference between draws and distributions and dividends? When should an owner take W-2 instead of distributions or dividends? And what are the differences between distributions and profit? It's complicated. These are questions that you need to ask once you know what kind of entity your client is. And since we're talking about what kind of entity a client is, sometimes you get clients who come to you and they're just starting, and so they don't have any tax returns yet. Get the proof of entity choice. Again, the stories I could tell, but we'd probably need cocktails and it would be way too long for one of these sessions. The stories I could tell about mistakes in entity choice and not finding out ahead of time what entity really was elected. Get proof of that. And if the entity hasn't been selected yet, join that conversation. If you hear your client saying, well, my uncle's barber says S Corps don't pay tax, like, that's why I should be an S Corp. Like, no, be like, hey, involve me in this conversation. Educate yourself, do some research, take some classes on how these entities are different from each other, and don't just let the client make a decision in a vacuum. At least ask them to go to their CPA and say, hey, what should I do? And if they don't have a CPA, recommend one for them. Recommend one that you like working with to them. The other thing I want to say about startups, this is purely a bookkeeping thing. A lot of folks don't know that you actually have to capitalize organizational costs and startup costs until operations begin. These are generally treated as intangible assets and written off over time once operations start. Okay? Very complicated thing to know about tracking all that stuff, especially if they're in the startup phase for many years. But you can't just write all that stuff off on a tax return if you haven't started operations yet. Okay. This is, I think, the area where I get the most questions. The special treatment and tracking of different lines in your chart of accounts depending on what kind of entity, for example, the special rules for things like auto expense and meals and entertainment. This, again, you don't have to memorize all this. Know that these are the areas where things get tricky. We'll start with auto expense because it's the one I get the most often. All right, here are the rules. If the company owns or leases the vehicle, the costs go on the profit and loss. If the company owns or leases the vehicle, whether it's for the owner or for the use of employees, those costs go on the P&L, in which case there are special rules for personal use of that vehicle that have to be added to the W-2 of any employee, not just the owner. Okay, so that can be tricky. If the vehicle is owned personally, the company can reimburse the employee using the car or truck or whatever, using either the standard or the actual basis under a written accountable plan. Okay? If you're reimbursing under an accountable plan, then those reimbursements go on the P&L as well. Now, how does standard versus actual auto expense work? You need a mileage log or app like MileIQ or something for both approaches. Okay, it's not like you don't need a mileage log for one and you do for the other. I have clients constantly being like, well, I don't want to have to track a mileage log, so I'm going to use standard. No, you have to have a mileage log. Get a mileage log. Get them used to using a mileage log or an app. This is an area where you can be a hero. That CPA at the end of the year will love you if the client comes in and they have all of the support for everything that they took as mileage expense. They will love you, okay? Standard method is simply the number of business miles times the IRS rate. Right now that's 62.5 cents per mile, but they update it all the time, so check. This year they even updated it halfway through the year, so check. So standard's easy. I love standard. Standard's so easy. But if you got a really pricey vehicle, you might want to use actual. Now, actual costs include depreciation. And that's why if you got a pricey vehicle, it could really be worth it. So in this case, you take all of the actual costs, seriously, like instead of asking questions like, well, does this count? Does this count? Does it? Yes, they all count. Take every actual cost, including depreciation, times the percentage of business use. So you drove this many miles this year and half of them were business use, you get to multiply half of the actual costs. And that's what you take. Now, I like to track for clients who are using actual method. I like to have a whole section under distributions for vehicle expense, under distributions. And then they can put they can pay all of this stuff through the company. You can track it all. And it's so easy for the CPA at the end of the year to just look at what that is, or it's easy for you to look at what that is every month and reimburse them, and then true it up at the end of the year. So if the owner wants to use the actual method, that's what I recommend. If the owner of the company is flighty as can be and cannot track any of these things and cannot use the company credit card for all of these costs, actual, even if they have a pricey car, actual is not going to be better for them because they're not tracking these things. If they are not able to do this, just do standard. It really is going to work out better for everybody involved. All right, charitable contributions. Political donations need to be broken out separately from charity as they're non-deductible. Consider even putting the word non-deductible after it in your chart of accounts. All entities except for C Corps are going to take regular charitable contributions as a deduction on their personal return. So if something's really promo or advertising, even if it's to a nonprofit, if you gave money to a nonprofit to get your name in the program or, in all of the advertising because you're trying to do a promo thing, well, then book that as promo or advertising. The company gets to take the deduction, which is generally a way better deal. Health insurance. Generally, employees are tracked separately from owners. Just track employee health insurance separately from shareholder, employee, or owner health insurance, especially for an S Corp, because that's got to be included in wages. I normally make the S Corp shareholders' health insurance a sub-account of their compensation. Home office costs. These generally do not go on the P&L, but we like to track them. So consider doing the same thing I was talking about before for auto expense for the actual method. Have home office and a bunch of sub-accounts under it be a sub-accounts of distributions. So it's a really good way to track this stuff for your client, even though it's not going on the P&L. This one's easy. Keyman insurance is non-deductible because Keyman insurance proceeds are non-taxable. Easy. If you end up with them paying Keyman insurance, put it in a separate account, write non-deductible after it. Meals and entertainment. Okay, business meal rules changed with the TCJA 5 years ago. It was 50% deductible for most, but if it's employee meals, they were 100%. That's not the case anymore. It's 50% for employee meals also, unless it's a firm function. We'll talk about that in a minute. Generally, everything's now only going to be 50% deductible. So consider writing 50% deductible after the account name in your chart of accounts. This is an important rule. You must be meeting with a colleague, client, vendor, consultant, employee, or some sort of business associate for it to be even 50% deductible. I see a lot of McDonald's and Taco Bell and Starbucks that are clearly for one person. These are not business meals unless they're out of town for business. They're out of town for business, that's okay. But you cannot just, I'm working really hard today. I don't have time to cook for myself. I'm going to McDonald's. That is not a business meal, okay? You can't do that. Same for gas station drinks or snacks. I see that all the time. Not a business meal. Distributions. A firm function is 100% deductible. Now, this is something you're doing like 2 to 4, maybe 5 times a year. You have an event like a company picnic or a holiday party or like a Zoom happy hour. Pizza every other Friday is not a firm function, people. Okay? I don't care how much you want it. It is not a firm function. That is regular. That is 50% deductible. Entertainment, no longer deductible, but it can affect basis. So it's still worth tracking on the P&L, but consider putting the phrase non-deductible next to it, like political contributions. Penalties and settlements, also non-deductible. These are parking tickets, alarm tickets, tax penalties, etc., not deductible. Interest is, so if they're getting charged by the IRS for a late tax payment and part of it was penalties and part of it was interest, split that. Split that. Interest expense is deductible. Penalties are not. So these do affect basis. So again, consider writing non-deductible after the account name. Other income and other expense. I got a lot of people who get confused about why those even exist. Why are they different than the rest of the chart of accounts? Why are they sitting down there at the bottom? It's not the same as miscellaneous. It's not. These are non-operating income and expenses. So interest income or expense, atypical revenue like grants and the ERC and PPP and all of those things that we saw a bunch of RRF during the pandemic, adjustments for prior years. Often you'll also see depreciation and amortization down there, gain or loss on disposition of an asset. These are not normal business things, right? Like if you're not in the business of doing the thing, it probably belongs here. So like I actually have a client who they gave her money to rent her place out while they filmed a TV show there. It was really cool. She's not in the business of doing that, right? That's other income. That is not her normal operating income. And the reason that you're doing this is that it allows you to compare trends year over year or month over month or quarter over quarter without some like one-time weirdo things getting in the way. And then gain loss on disposition of assets. When an asset is sold, put that income in this account so that later the CPA can more easily identify it. What's going to end up happening is that the original asset and all of the accumulated depreciation that's been happening through the years for that asset, those are going to be written off to that same gain loss on disposition of assets account. And so the difference, the income and minus the accumulated depreciation and the original cost and all of that, it's going to be reported on a special form on the tax return. We're going to talk more about assets later, but know that this is a special account and you should know how to use it. As I was saying, I like to track anything that might be useful for the client in QuickBooks, even if it's not directly business related, like the auto expense and, self-employed health insurance. That's another good example. You can help your client track and organize this, and they're going to love you so much because the CPA is going to love you because they're asking the client year after year for this stuff and the client doesn't know where to find it. So the CPA is going to love you. Your client's going to love you because their CPA is not going to be getting on their case being like, hey, how much did you spend on health insurance this year? That kind of thing. All right, quarterly estimated taxes. Bookkeepers can learn to help clients recognize when their quarterly estimated taxes that they've been paying might be way out of line with the actual income for the new year or quarter. All you have to do each month or quarter or year, but let's remember, you're the first line of defense, so do this as frequently as you reasonably can. Run that P&L, compare the year to date to the prior year. Click that little prior year comparison checkbox at the top and take a look at it and look at the change in the bottom line. If there's a big difference in either direction, say something. the CPA isn't going to know about it until it's too late. They're not going to find out about it until tax time. And then the person's way underpaid in or way overpaid in, and they could have used that money for something else. Say something. Say, hey, I think you might be underpaid. I think you might be overpaid. I don't know. I'm not an expert, but I'm just giving you a heads up here that you should probably talk to your CPA, do like a mid-year tax planning session. Also, you can suggest to corporation owner employees, S Corps or C Corps, remember they're getting W-2. You can suggest to them that they increase the amount of their W-2 tax withholding, and then they can make smaller quarterly estimated tax payments. I know, it's so cool. When people find this out, they generally get really excited about it. My clients love that because they're like, I hate saving up for quarterly estimated taxes. Another thing you can do is anyone can make estimated tax payments online monthly, daily, weekly, however often you want. Just go on there, say what year it's for. If the client can't save up for the quarter, help them out. Be like, hey, you know, IRS has direct pay. Most states have a way to make payments, estimated tax payments on their website. And you can help them say, hey, why don't you pay in $1,000 a week instead of trying to save up for an entire quarter? It can really, really, really save a lot of headache. Let's talk about assets. I said I was going to circle back around to them, and here we go. The rules for capitalizing versus writing off something. Now, capitalizing means it becomes an asset and gets written off over time, generally gets written off over time. Or writing it off is like expensing it on the P&L right when you spend the money. So first you have to look at how much it is, what the capitalization threshold is. Now the IRS has a safe harbor of $2,500. This is an expensing safe harbor. Even if the thing would otherwise be considered an asset, they're just like, look, if it's under $200 or $2,500, you're allowed to expense it, but you have to have a written policy. It's not automatic. You have to elect it, okay? So have a template that you can give to each client and make sure they fill it out saying, we have elected for our capitalization threshold to be $1,000 or $1,500 or $2,000 or $2,500. You can't go higher than $2,500, but you can go lower if you want. And it's very important to consistently apply it. You can't say, oh, well, this time I don't want to capitalize it and next time I do. No, once you make that decision, everything under that amount, you need to treat it as a write-off, as expensing, as opposed to capitalizing. If the amount is above that capitalization threshold and they have a written policy and all of that, then for equipment, furniture, and fixtures, the rule is if it has a useful life of over 1 year, it should be capitalized. Repairs, the rule is that it meets one of 3 IRS regulations: betterment, restoration, or adaptation. You don't need to memorize these things. Just know there are 3 things out there. If it qualifies as one of those things as opposed to just maintenance, and it's over the capitalization threshold, then it can be capitalized. It becomes an asset. Attach invoices and write memos for any large purchase, repair, asset, whether it's on the profit and loss or the balance sheet. Don't make the tax preparer chase down those details. You know those details. You're doing the books. Attach those things, write those memos. Say, I left this in repairs and maintenance because it doesn't meet the IRS capitalization rules. You know, like put that, communicate via the memo. And then at the end of the year, oh my gosh, you have just made that tax preparer's life so much easier. I can't even. Get a copy of the depreciation schedule from the tax preparer or the client. Consider booking it as a monthly estimate of what you think it's going to be for the upcoming year, for the current year, to keep the financials comparable. This isn't required, but especially for bigger companies, it can be really useful. We talked about gain and loss on disposition of assets and tracking asset acquisition and retirements. If somebody sells one of those things, put it in the gain or loss on disposition of assets. When those things are being written off because they've been gotten rid of, it's going to go into that same account. Review equipment and tenant improvements when a client moves offices or remodels. You're going to know about this. The CPA might not even know it happens, right? But if you're like, oh, they're moving offices, or you know, they're closing this office and opening this new one or whatever, ask about the remaining security deposits on the balance sheet. Review the equipment and the leasehold improvements with the client and say, hey, which of these need to be retired? Keep notes for the CPA at tax time. You're going to save them so much work, and you're going to save the client a ton of headache, and you're going to be amazing. Also, ask about writing off the obsolete assets. I promise you, no one is using their 2004 cell phone or computer. Okay, get rid of it. It's just clutter. Make sure the total assets in QuickBooks match the total assets on the depreciation schedule, just that total dollar amount, and that the total accumulated depreciation matches it as well. Keep that going every year, clean it up, make sure it's right, and then keep it like that moving forward. It'll save you a bunch of headaches as well as the client and the taxpayer. Okay, best practices in year-end review. You must review the financials before handing them off to the taxpayer. You must, please review the financials before you hand them off to the taxpayer, even if you've been keeping the books, especially if you've been keeping the books. Because that taxpayer gets these financials and they're like, how come there's a negative asset or a negative liability, or there's some weird stuff on there. They're not going to trust your work. They're not going to refer business your way. Make sure everything's as clean as possible before you give it to them. Work that year-end review into your fee, though. Don't give it away for free. Don't give your expertise away for free. Keep in mind that you are saving the client money on their tax return because it's less work for the CPA and because you're going to catch things that otherwise might get missed. For your own sake, try to do as much as you can on a monthly or quarterly basis, like reviewing for possible 1099 vendors and making sure all the payees are assigned, especially for larger items and charity. That's really, really important. Document your review and share it with the tax preparer. Then there's no duplication of efforts. They know you already tied everything out. You can attach your bank and credit card statements to the reconciliations, and then they don't have to double check it. You can attach the inventory count to the final adjusting entry. Note these things in a list and say, already did this, already did this, already did this. Seriously, you'll be a hero to everyone involved. Well, your client won't even know it happened, but they will be happy that the CPA is happy with you. So what you really need to do is proof the balance sheet. Now, Cindy's doing a class coming up that is called Check Your Work, I think, and I think she's going to cover some of these things in that class. But proofing the balance sheet means that every balance that's on that balance sheet, it has something that it ties to, right? Like it has a source of some type. So your bank and your credit card statements, attach those to the reconciliations. You know that those balances are accurate. Attach your inventory account to the final adjusting entry, for example. That's what that ties to. Review your asset additions and retirements with the client. Attach invoices. Ask to write off obsolete assets. Present this info to the tax preparer at tax time. It will be a gift. They will love you so much. Make sure the payables accounts zero back out the following period. So like your sales tax, when they make that payment the next period, it zeroes that account out. So you know the balance as of, let's say, 12/31 is accurate. Tips payable are another one that's like that. Confirm the loan balances. Confirm those loan balances. Get the statement. Fix those unapplied cash payment things. Honestly, I hate those so much. It just means like the dates aren't in the right order on your invoices, but look at whether it's vendor invoices or customer invoices, because then you have the other one, unapplied cash payment income and unapplied. Oh, I hate those things. Just get the dates right. If you put the dates in the right order, then you won't have anything on there when you convert from accrual to cash basis when you click the little button at the top. And review the profit and loss, but you don't need to do quite as much work there. If the balance sheet is correct, we know the net income on the profit and loss is good. It has to be. If the balance sheet's correct, the net income on the profit and loss has to be accurate. So you're really just reviewing the profit and loss for reasonableness. Pay special attention to accounts that are non-deductible or partially deductible. Tie out the income to the 1099s received on each sales channel. Reconcile the amount that it says is the payroll expense for the year to the W-2s, and compare to the prior year for trends and outliers. When accruing expenses for a cash basis taxpayer, be really careful because journal entries are not considered. They're not taken into account by QuickBooks when switching between cash and accrual basis. So be really careful with those. It should be really easy for the accountant to be able to adjust for any accruals because they don't apply for tax if you're on cash basis. Do not adjust prior years after the tax return has been filed and the adjusting entries have been made, unless you are only changing information that would not alter the financial statements or the 1099s. The amount of work involved for the tax preparer in tracking down a change in retained earnings is just enormous. It's so awful. And most will charge the client for this. So anything you can do to make their lives easier is not only going to be appreciated, it's probably going to save your client money. Lock the books, close them in QuickBooks, lock them, password protect, don't change a prior year without telling the accountant. This includes voiding checks issued in a prior year or using the write-off feature in QuickBooks. QuickBooks handles them wrong. They've never gotten it right. I don't get it. I don't know why. It drives me insane. An entire session, honestly, should be devoted on how to tie the books back to the tax return and the importance of that step. Know that it's an important step. Once that tax return is done, go back in and make sure that CPA didn't mess you up, okay? But how to actually do that is a little bit complicated and outside our scope here, but know that it's a very important step. All right, almost there. How to talk, yeah.
Okay, I just want, so we are at 2:53
Great.
already. So
Awesome.
I just want everyone to know we will be going over the hour. So just want to let you know that. Nancy said she'll stay on a little bit longer as well to answer some questions. So if you do need to jump off at the top of the hour, feel free. I will be sending out a recording of this so you won't miss anything. So I just want to let you guys know that.
Awesome. Thank you so much. Sorry that I'm going over a little bit. I just get so excited and I always end up providing more examples than I had in my notes.
This is great information. So
oh, good. I'm glad.
Great.
Okay. Well, to wrap up here, I mean, one of the most important things here is interacting with the tax preparer, right? Like how to speak CPA, how to talk tax speak. One of my team members told me that her biggest challenge, and this just made me so sad, but also I get it. It's true. Finding CPAs willing to interact with the bookkeeper. She said, her exact words were, it's like they're too busy or snooty to share information with a lowly bookkeeper. And that just like breaks my heart. That's ridiculous because we all know garbage in, garbage out. If the books aren't good, your tax return's not good, right? So I want CPAs to build a relationship with the bookkeeper. Bookkeepers should be trying to build a relationship with the CPA or the tax preparer. If you are working with somebody who treats you like you are less than you are, don't work with them. Don't work with them. Recommend to your client that they switch. Find tax preparers that respect your work and recommend them to your clients. If you have to work with them, if you cannot get out of working with them, show them clean books and earn their respect. Ask good questions. Show them that you want to learn more so that you can help make their job easier. Having a relationship that goes in both directions is going to make both of your lives easier. Ultimately, you both have the same goal, trying to serve the client, right? CPAs that don't really care about how the books look, please avoid them. I mean, it just surprises me. The ones who want a PDF of the P&L and then they cruise through filing the return and they just enter those numbers, I can't stand it. This helps no one. And how do you file a return for someone whose PayPal account has like a balance of negative $100,000, right? Like you're not legally, you're supposed to look at that as a CPA or any tax preparer should look at that and say, there's something wrong here. I need to ask questions, right? Avoid working with those people as much as you can. You need to protect your client from the consequences of working with this kind of tax preparer. A clean balance sheet means a clean tax return. So get that balance sheet clean, work with the tax preparer to make sure that any questions are addressed. Coordinate with the accountant. If you have questions or concerns, do not wait until April 14th to raise them. And by the way, the deadline for corporate tax returns is actually March 15th. So don't wait until March 14th to raise them or for the accountant to catch them. Oh, that's okay. The tax preparer will catch them. The closer it gets to the due date, the less likely they are that they're going to catch them, right? Reach out to them, establish a relationship with them. Also, another way that you can talk with a CPA or whoever's preparing the taxes, use those memo and description fields. Asset descriptions, sale of assets, items and other income or other expenses, even a miscellaneous expense, or when you book a large payment to repairs and maintenance or office supplies or similar accounts. Write notes, love letters to your CPA in those memos. A good one is going to be looking at them. When you get those year-end adjusting entries from the CPA, make sure you understand them. Don't just book them because they said so. Pay special attention to reversing entries. Some of them say reverse the following year, and you'll just enter it and then it won't get reversed the following year. That's an important thing to keep an eye out for. And here's something you're going to be way better at than the CPA probably will. Know when their adjusting journal entry really should be a credit memo or another source transaction. You know this better than the CPA does. Also, you can help the CPA by tracking non-bookkeeping notes and points for next year, PNYs, like deposits and gift cards that were declared as income on the return for a cash basis taxpayer, things like that. They could really use your help. And if you've established a relationship with them, they're going to say, hey, when this kind of thing happens, can you write it down on a list to give me at the end of the year? Super helpful for everyone. So here's a list of takeaways. I'm not going through the list. You guys will all get a copy of the slides. The main thing is that when you keep in mind where these areas that are listed on this slide, where those areas of complexity are, you will save your clients money, you will save tax preparers time, and you will show your value to everyone involved. All right, that's all I got.
So I think that we need to do like a half-day session.
I should probably point out, I mean, I have a master's in accounting, a CPA credential, and 21 years just running my own firm, not counting the years I had beforehand. It's a lot. You could spend a lot of time doing this, but the point is that you don't have to spend a lot of time doing this. Just know where the problems are likely to be and then look them up one by one. You don't have to learn all of this in 1 hour or a half day or a week or anything like that.
So some of the questions. So Melissa asked about there was 100% deduction for meals that came about.
That one, yeah. So the 100%. Oh yes, okay. That's it. I didn't bring that one up. I know what she's talking about. Melissa, I didn't bring that one up because that's only for this year and last year. It's anything that is eaten at a restaurant. Those meals are actually at 100%. But I'm not telling anybody to create a separate account line for those. Actually, what I am asking people to do on our team and also bookkeepers who work with the clients for whom we're doing taxes is, hey, can you export the meals account and then go through and add up which ones were at restaurants? If you guys can just give us that number, that's going to be a lot easier. If they don't do that, though, that's exactly what we're doing. For a 2-year 100% write-off, like it's not worth changing your chart of the structure of your chart of accounts, in my opinion. I do know people who are doing it though, and that's fine. If that, all the better. You can always merge it back in when the pandemic's over.
One question I had, because we deal with a lot of residential painters, and I know you you mentioned the gas station food is not allowable.
God.
So for us, like if they worked in an office and they bought water for the office, wouldn't that be considered
Totally.
office?
Well, that's office supplies. That's actually 100% deductible as office supplies usually. I mean, you can make the argument that certain things that just are in the office all the time, and it's not a meal. I mean, water's not a meal, right? Right. I don't think it is.
But so if when they're buying water, they get gas and water, how would you account for that?
I mean, if it's really just water and it's an office supply, I mean, that's normally not what's happening. Normally they're buying a Coke. I don't know how many people are doing. They're normally buying like potato chips and a Coke. Let's be honest here. I mean, if you want to split that bottle of water out to office supply, you can. If you want to, to be safe, I probably would just stick all of that in meals. Now, it's not that it's non-deductible. It's just that it's 50% deductible. When I'm talking about like most of the stuff I'm seeing, they're like on their own. the owner is like driving somewhere and they're like, I'm hungry, and they write it off. Like, that's not the same as a contractor on a job, right? Like a contractor on the
Sure.
job that you're buying water for, that's just something they need because otherwise they're going to like faint in the field. I don't know.
Right.
That's,
Well, that's it.
yeah.
Okay. That's
I'd
personal
argue
question.
you could put that to office expense, probably safer to put it to meals.
Jenny had a question. What about assets bought in a hodgepodge? A computer
Mm,
with multiple components where the
great
total is over
question.
2,500, but parts are not each
Yeah.
over 2,500. Office furniture set where each item
Yep.
is under 2,500.
That is an excellent question. It's actually something that um, it's something that we kind of struggle with on this end when we're separating assets after the fact on the tax return is each one of these a separate asset or is it a group of assets, you know? And it's really facts and circumstances. Generally, I would say if you're buying office furniture, I mean, like each chair is not an asset, but together, all of the chairs and the desks is office furniture. You know, chairs and desks is one asset if it's over $2,500. That's how I would tend to book it. If you buy one chair as a replacement, though, that's just expense that on the P&L, right? Like that, it's not just because it doesn't reach the threshold. It's because it's you already have capitalized the set and you're just replacing something in a set. Happens with restaurants, also with silverware a lot. It first when they first buy all of the plates and the silverware and everything for the restaurant, that's an asset. As they replace the worn ones throughout time, that just gets expensed. Now, with computers, it can be a little bit complicated because you do end up with a situation where, you know, was it one computer with like the monitor, the CPU, the all of the accessories, et cetera, and so on, the shipping costs and all of that, that would be considered one asset. If you're buying, so like there might be 5 charges for different things, but it's all one workstation, right? Okay, so that's one asset. It gets a little complicated when you buy 10 of those at once for the company. And I would say, you know, if you're dealing with large numbers of things like that, probably best to, unless they're actually going to keep track of the serial numbers on each one, they're not going to know which one they retired. It's more like the tables and chairs where they buy 10 at once. That's office computers, you know, and you can put that all in one asset. It's all being depreciated at the same rate, right? The only reason that you want things to be separated as much as you can get them separated is if you retire one thing, but not all of them. If you're talking about 1 out of 10 computers, you know, that it's not even going to qualify probably above the threshold. And so saying office computers, saying office furniture, like that is reasonable to do. If you're only buying one computer, know that all of the accessories and the monitors and everything should be included with that as one asset.
Awesome. All right. What is the difference between organizational costs and startup costs?
Oh, great question. Yeah, they're basically the same thing. Organizational costs are just the costs that you spent to organize or incorporate the business. So that would be the actual filing fee with the Secretary of State. It would be like if you paid to get stock certificates issued, things like that. Organizational costs tend to be tiny. Startup costs is like everything else. And so the way we handle that, we work with a lot of co-ops and like co-op grocery stores take anywhere between like 3 and 10 years to finally open up. And so we actually have an entire chart of accounts like you would normally expect there to be a chart of accounts like on your profit and loss, you know, you have meals and you have repairs and you have legal and professional and you have office supplies and all of those things. We'll have that whole thing under an asset called startup costs and then sub accounts for all of them. So they can still keep track of what they're spending money on, but it's all being tracked as one asset for our purposes. And the only thing that we adjust on that before we start writing it off when they start operations is the things like meals, which you know you adjust for 50% before you start writing it off and things like that. So startup cost is pretty much everything except for the actual incorporation or organization documents and the work that it takes to get those documents. The reason that there are 2 different names for it is kind of a technicality. You're allowed to write off a small amount of each of those in the first year. That's why they're different.
Excellent. All right. So this is kind of a two-part question. So can you explain a little bit the difference between, you already did a little bit, but just do it again, draws, distributions, and guaranteed payments?
Yeah.
And then the second part of the question is, in theory, if they've been recorded wrong the whole time, can you still change them?
Great question. Wow. I'll actually answer the second one first. If anything's been recorded wrong throughout history, you have your client has a decision to make, and this is a really good opportunity to develop a relationship with the CPA. Have a meeting with you and the CPA and your client to say, look, stuff's been done wrong in the past. Is it small enough and isn't affecting the bottom line of how much they're paying in taxes that it's really not worth the effort to the client? The client's the person who makes that decision in the end. You guys can make recommendations, but ultimately the client decides whether or not they want to file an amended return. If something's been done wrong throughout history, but at the end of the day, an amended return wouldn't substantially change the taxable amount, then it's probably better, and here's one answer to that second question, it's probably better to just force the books to match whatever those prior returns have looked like. You can do a journal entry on 12/31 of every single year, just force the books to match. And any difference through the years, stick it in other income or other expense for the current year and pay the difference on that tax now. That's if the client decides not to amend all of those other years, okay? The second option there would be if it makes a difference in the bottom line of how much tax they are paying, or you're blatantly doing something wrong, like filing the wrong type of entity tax return. I've seen this too many times, unfortunately. You need to recommend that they amend those prior returns. And unfortunately, with CPAs put in a position where if the client refuses, they're supposed to disengage with the client and say, I'm sorry, but you've actually committed fraud here. You need to go back and amend these. I can't force you to do it, but you also can't force me to work with you. So, you need to have some sense of how much of a difference it's making. So can you go back and change them? The books, at the end of the day, the books have to match the tax returns. Nobody will ever survive an audit without it. The books have to match the tax returns. Doesn't matter if the tax returns are wrong. The books have to match the tax returns. So can you go back and fix it? I don't know. Can you? Do you want to? To go back to the first part of the question, guaranteed payments, draws, distributions, all of that. So for a partnership, you're really just looking at two things, guaranteed payments and distributions. They're often called draws instead of distributions because they're treated the same as draws for a self-employed person, okay? So in that context, in the context of a partnership, draws and distributions are the same thing. Distributions for an S Corp or a C Corp are potentially different. So this is why I'm saying in the context of a partnership. So you've got your draws or your distributions, whatever you want to call it, in the partnership. You've got guaranteed payments. Guaranteed payments are really just a way to say, I earned this for performing services. There is something called guaranteed payments for use of capital that is way above we're just outside of this topic here, but you should know that's also a thing. So if you're Googling guaranteed payments and you see that one, there is this other thing too. Mostly guaranteed payments are for services rendered. So let's say that, Cindy and Jenny and I own a partnership together and I do almost none of the work. I'm just like behind the scenes and, I do like a little bit. I only get paid maybe, $2,000 a year for the services that I'm rendering. Those should probably go under guaranteed payments. Cindy's doing, almost all of the work for this company. She's going to make a lot of money for her guaranteed payments, right? Because it's like in lieu of payroll, right? And then Jenny's somewhere in between. If our operating agreement says we split the profits 3 ways, we are equal partners, we split the profits 3 ways, but Cindy's doing way more work and Jenny's doing medium amount of work and I'm hardly doing any work. Well, it's not fair to split the profits 3 ways unless we take the guaranteed payments out first. That's why guaranteed payments go on the profit and loss instead of the balance sheet, even though they're taxed exactly the same, is that we need to pull out the mammoth amount of work that Cindy's done. We need to pull that out of our profit. We need to, the medium amount of work that Jenny's done, the small amount of work that Nancy's done, we pull that out of profit. What's left in that profit, we're splitting 3 ways. That's why that distinction exists there. And it would be the same kind of thing if we were in an S Corp. We would each be W-2 employees, right? And Cindy would get the most, and Jenny would get the second, and then I would get a much smaller amount on my W-2. Those get pulled out of profit, and then we split it 3 ways or whatever. You got to look at the operating agreement. I mean, that's something I wanted to add to this, but it was already so long and so much information. But you really should be looking at the operating agreement for that company and see what it says. I have clients who split everything 50-50, and as a result, they don't even bother with guaranteed payments. They're like, we're just going to split everything profit. You don't have to have guaranteed payments. And then it got to be really complicated when one of them stopped showing up to work because they were busy all the time. And, they were like, you know what, let's change our operating agreement and say that we're going to do guaranteed payments first, and then we're going to split everything 50-50.
Excellent. All right. There was a question in regards to, where did I see it? I just want to make sure to mention it. The health insurance on a S Corp.
Mm-hmm.
So
how does that work?
I know, I think you said, no, it was just a question of how do you record it. So I think you mentioned on the profit and loss, you have a separate account called owners.
Yeah.
Health insurance.
Exactly. So there'll be health insurance benefit for employees. And then I split out the health insurance benefit for owners and spouses of owners, actually, and anybody who could be considered an owner by the related party rules. Anybody who's greater than 2% shareholder or related to 2% shareholder. I put their health insurance in a sub account of their shareholder compensation. So that's another thing, right? You've got your payroll and you've got wages and salaries, and then you've got shareholder compensation separate from that because it has to be reported. Goes back to looking at the tax return. There's a line for shareholder compensation. You can't report it along with everything else. It's separate. So you have a separate line for that, and then a sub account is how we do it for shareholder and related party health insurance goes underneath that because those together are going to go on box 1, but not boxes 3 or 5 of the W-2. It's complicated. It's a stupid rule. I hate it. It's so stupid, but it is a rule. We need to follow it. So yeah, separate shareholder compensation, separate shareholder health insurance, make shareholder health insurance a sub account of shareholder compensation if you want.
Okay. This one, just clarification, I guess, are meals for the convenience of the employer at 100% or 50%?
50%. They used to be, that used to be the rule until the TCJA 5 years ago. Meals for the convenience of the employer used to be at 100%. It has changed. They are now at 50%, except for the occasional firm function, which again, if you're buying drinks for everybody, on happy hour every week, once a week, that's not a firm function. So firm function is really just those occasional things. And they don't quantify that. Unfortunately, in the code, they don't tell us what that is. It has to be, reasonable and necessary, just like everything else. And it just has to not be like gratuitous, basically. So your client, your CPA, and you can, look at facts and circumstances there. But meals for the convenience of the employer are now at 50%. That was the big change.
Okay. This is in regards to assets that if a repair is bringing the property back to standard, not an improvement, should that be treated as an expense versus an asset over $2,500?
It is a great question, and you're going to hate my answer, which is it depends. Actually a really, really big section of tax code that is kind of complex. And I have a whole write up on it that um, if whoever asked that question, would like me to send out something more comprehensive later on, I can do that. But there are sort of like three tiers of things to look at. Um, if it was non-functional and now it has become functional, asset. If it was, not in great shape and now it's in better shape, not an asset. That sounds wishy-washy, but there are specific rules to it, and it's honestly, I could do an entire hour just on that. So if you remind me about it later, I will send something out that you can send out to clarify
Go
that.
check out Nancy's blog page.
Yeah, I'm sure I
it's
wrote
on
a blog.
there.
I'm sure it's on there somewhere. If
Uh,
not, I should. I'm going to have a write up about it. So if I haven't already written a blog post on this, I should now.
There's another one. I'm not aware that our company has a capitalization policy. So in that case, where should Microsoft Office cost $500 software be categorized as an expense or an asset?
I mean, $500, honestly, in pretty much anybody's eye, even if you don't have a capitalization policy, at this point, a $500 expense is almost always office expense. I mean, that's not considered a large expense. I would not put the effort into capitalizing that. However, if we're talking about rules, you know, yes, you have to have a written capitalization policy. Google written capitalization policy example and find a template, and it's like one paragraph. Our company has decided that our capitalization threshold is going to be X dollars. Okay, it can't be higher than 2,500. Yes, it has to be written, but I will be completely honest with you. Before I hired another CPA at my firm, I didn't bother to have anybody have a written policy. We just said, hey, for most of our clients, we used $1,000 for years and years and years. We were just like, for most of our clients, $1,000 is a big enough difference that we should say if something's $1,000 or more, it should be capitalized. But it was sort of just like, it wasn't a rule that we followed. It was just sort of guidance. It was a recommendation, et cetera, and so on. Then they created the $2,500 safe harbor, and it was around that time, or just maybe a couple years later, that I brought in CPA, and she was like, dude, you have to have a written policy. And I was like, oh, you're being so particular about it. And she's like, no, I actually saw a situation where it got disallowed on audit. And I was like, oh, well, never mind. Like, okay, I'll do that. And I just found a template. And now at the end of every year, that's one of the things that when the bookkeepers are doing their annual reviews on our clients, they ask the client, do you have one? No, here's a template, please fill it out. So if you want $500 to be your capitalization policy, you can make $500 your capitalization policy. It depends, for a really big company, $500 is like a drop in the bucket. For a really small company, $500 might be really significant. So that's why you're allowed to choose what your threshold is going to be. I'd stick it in office expense.
Excellent. Okay, going back to guaranteed payments, where does that go on the profit and loss?
That's a great question. Actually, there are like 3 different places it could go, and it really depends on your client's needs, but I've had it set up in different ways for different clients. My favorite, and this is weird, this is not like standard or normal or anything, I often will put guaranteed payments in other expense all the way at the bottom, because that way they can think about labor costs that they're paying out of pocket without having to include themselves in labor costs, or like, if they don't, if the owners don't really think about their labor because it's free as far as they're concerned, right? Which is the case with a lot of our small businesses. Like, they don't really think of, they want to know, how much am I paying out of pocket to other people, right? And so they don't want to see their numbers messed up in there. They want to know how much profit they have before they decide whether to pay themselves those guaranteed payments. Sometimes, even though it says in the operating agreement, you're going to make this much, they might not have the cash, right? So sometimes I will put it in that other expense that's weird, and you would want to have a conversation with the CPA about the fact that you did that so that they know where to look for it. But that's, I mean, in these cases, I am the CPA, so I know where it is. The other 2 things where you could put them where it's like way more normal is just under cost of labor. You know what I mean? You've got payroll,
or cost of labor, and you've got the different things that go under payroll or cost of labor. Guaranteed payments are part of that. I mean, it's payments for services, right? So, especially if they're thinking about selling the business at some point to somebody who maybe doesn't want to be an active worker, that person is going to need to know, well, how much did you spend on labor, and the guaranteed payments, should be there. Um, but you can also put it in like a different section of the profit and loss. If you don't want it under payroll because it's not payroll, but you could have like cost of labor being an overarching thing, and then payroll, and then guaranteed payments, as two different sets of sub accounts. That's a way you could do it. Um, it does need to be on the P&L though. I think that's the important part. And it needs to be in keeping with the operating agreement. So read the operating agreement.
Okay. Going back to the meals, if a firm has a weekly meeting, Saturday donuts, is that a no-go?
It's still 50% deductible.
Okay.
It's still 50%. It's not like it's not deductible. And if you buy those donuts from a restaurant, then this year you can take 100%, right? So I don't know.
All right. Last question. This is a good one from Vivian. So she's asking, do you recommend taking a tax refresher tax class or just reading sections of the irs.gov that apply to our concerns?
That's a great question. I guess I would say it depends on what you're wanting to do with that knowledge. I would say ideally that you should talk to the person who is preparing the taxes for that client and say, hey, these are some areas that I'm curious about. How do you like to see it on, in the books, and how are you planning on treating it? I'd like to learn more. One of my team members actually, um, who I met through Jenny, one of my team members created a relationship with a CPA in her little town and said, look, I'll work for you for free or discounted during tax season so that I can learn about taxes if you will be my mentor and you will teach me what you know about taxes when I have questions. They have a really good relationship. She doesn't do that anymore. She just did it for like, I don't know, 1 or 2 seasons or something like that. She learned so much of value. I would not say a tax refresher course is likely to help, however, only because in the past 5 years, the rules have changed so much that taking like an annual tax update course, they're going to presume you already know about the underlying stuff. If you really want to learn about taxes, Illinois Tax School has an online tax certificate or something like that they do that is really excellent. They've got a great workbook. You can do it at your own pace. So if you're really wanting to learn about taxes and kind of get more into it, I would go to the Illinois Tax. I think that's what it's called, the Illinois Tax School. And I've looked across the country to try to find other ones, and I haven't personally found anything better than that so far. The other one that you might be interested in taking is National Association of Tax Professionals, NATP, which does not require you to be a CPA or an EA to join, and you don't have to be a member to take their classes either. They're just more expensive. They have a tax preparation boot camp that you can do online, which is designed for people like me who run my own firm, and I have people on staff who I want to teach how to do taxes. They can take this boot camp and they'll learn everything they need to learn. So if you wanted a deeper dive, I'd say Illinois Tax School or NATP are probably your two best bets there. But really, if you have questions about very specific areas, Google them, and if you don't learn what you need to know, go to your favorite CPA and ask. I have a lot of people who work with me on the condition that when they have questions about things, I'll help them. I'll be their mentor. I'll walk them through it. So develop a relationship like that.
Or join Buds and put it in Slack.
Totally. There are at least 3 or 4 CPAs, 5 maybe. I don't know. There are a bunch of CPAs and Buds. Ask. And the thing is, if you're asking that question, there's probably another Bud that has at some point asked that question and can probably give you advice on it, even though it's a tax issue, because they're like, oh, I already asked Nancy and she said this, So.
Excellent. Well, this has been fabulous. So you have a raffle, you have a book to give
I
away.
have a raffle. Okay, I don't know if everybody knows this book. I learned about it from Bookkeeping Buds in Slack when people were asking about what can we give our clients to help them learn the basics, what they need to know about reviewing their financial statements. And somebody recommended this book. I don't remember who it was. I should go in Slack and look it up and thank them because I just think that this book is fantastic. I think it's interesting for us to read because it's interesting to see, we get so used to knowing what we know that we forget that we didn't know all of it at some point. And so this is really nice because it breaks it down into like, hey, small business owner, here's what we think you should know. And so it just helps you talk with them, even if you're not recommending the book to them. But anyway, I think it's a great addition to the practice and would love to give a copy to
Okay,
somebody.
pick a number. Pick a number from, I have a list of everyone who registers, so we're gonna hope that someone's on the call. So go ahead and pick a number from 1 to 60.
All right, 1 to 60. 52.
I'm sorry, Nancy's picking a number from 1 to 60.
I'm picking
Sorry
it.
for the
52.
confusion.
52.
Okay.
All right, so now you're looking at your list and seeing who registrant number 52
I'm seeing
is.
who's number 52 on my list, and it is Sarah. Oh, I'm gonna screw up your last name, Lurcher. Is it?
Lurcher, Sarah Lurcher.
I think she's on. Is she on?
Is she on the call?
Yeah, I'm on the call.
Oh my God, Sarah, you won this book. Do you already have it?
No.
You don't? You're gonna love this. This is great.
Oh.
You're totally gonna love this. I already
Oh my
have your
God,
address. I know how I can mail this to you.
That's
And thanks.
awesome.
Thanks, Joanna, for putting the name of the book in the chat. So if anyone was
Thank you, Joanna. Were you the one who recommended it to me initially?
She's not a bud yet.
Oh. Wow. All right. Well, yeah. Sarah, I will get this right out to you. Congratulations.
Awesome. Well, thank you everyone for joining us. Like I mentioned, the recording will be sent probably tomorrow, along with links to Nancy's website where you can check out her blog. She's got tons and tons of information out there, and we will try to get her back to do the reasonable compensation and the matching of the tax return course. So yeah, I'm thinking a full day, half day course, Nancy.
It'll be fun. It'll be hands-on workshop.
Yes, exactly. So if you enjoyed the webinar, please be sure to check out our future Lunch with a Leader presentations, or if there's someone or a topic that you're interested in learning more about, please drop that in chat. We're always looking for ideas, to bring new people into our world. Our next presentation is going to be held on September 12th. And that is with Dara Scalar, who is a Google guru. The course is the business changing magic of being digitally organized using the Google tools that you already know and love and probably are already paying for. So be on the lookout for that one. Again, thanks for taking time out of your day to join us. Thank you, Nancy. You're such a wealth of knowledge. I really appreciate you sharing with all of us. And until we meet again, dream big, shine bright, and be kind. See you all later.
Love you all. Thank you so much. Thanks, Cindy.
Yeah, absolutely.